Let's come back. Previously, we have talked about convertible bonds. Now, let's look into convertible bonds. Convertible bonds. First, I have to say convertible bonds is not a classical bonds. It is actually a financial derivative. We know traditional bonds. There are some fundamental elements such as face value, such as maturity, such as coupon dates, such as coupon rates. Okay. For convertible bonds, they also have these fundamental elements, but they also have another clause, which is called an option. The option allows the bondholder to convert their bonds into the stock of the bond issue. Convert the bonds into the stock of the bond issuer. This is a great clause. Under this clause, there are some quite interesting features for convertible bonds. For example, first feature, the price of convertible bonds usually fluctuate very much. While some of the ordinary bonds, their price fluctuations may be this way. This is convertible bonds. This is ordinary bonds. Why? Because of the option. There are two situations. First, the stock of the bond issuer price, if the trend is going upward, the convertible bonds price may go upward sharply, this way, maybe. Why? Because the convertible bond issuers, now they have a new source of getting high return. For example, the convertible price, say 100 RMB. While in the meantime, the stock price of the bond issuer may be 130. In this way, once the bond is converted, of course, at the price of 100, the bond issuer will quickly earn the premium, which is 30. So, activated, innovated by this one, the convertible bonds price may fluctuate very much, especially when the stock price of the bond issuer goes higher. The price of the convertible bonds goes higher as well. In other situations, if the stock price of the bond issuer gets downward, the price of the convertible bonds would be very low. It's pretty low. Because there are no additional return anymore. And the bond issuer already attached the option as extra benefits to the bondholders. So they usually provide a very low coupon rate for convertible bonds. This is the second feature of convertible bond. The most significant feature for convertible bonds is, besides ordinary bonds, there is another clause for convertible bonds, which is an option. This is convertible bonds. And then we have other interesting varieties of bonds. First one is called callable bonds. Callable bonds. Callable bonds means a bond that can be called back by the bond issuer before it matures under certain conditions. We say that a callable bond is riskier for the bond buyers. Why? Let me explain. Okay, this is a bond. This is a callable bond. This is its maturity. A callable bond means before maturity, the bond could be called back by the bond issuer. Or in other words, a callable bond is also an ordinary bond plus an option. The option allows bond issuer to call back the bonds before maturity under some conditions at premium predetermined price. From this option, we can see that this kind of bonds is favorable to bond issuers, but unfavorable to bond buyers. In this way, we call callable bonds is riskier in terms of bond buyers. Such as when interest rate is falling, the bond price rises. We will explain this later in the bond pricing models. Interest rate down, bond price up. Because of this, callable bonds is not as valuable as bonds that are not callable. So this is callable bonds. On the other side, we have another variety of bonds, which is called puttable bonds. A puttable bonds is an ordinary bonds plus an option. This option allows the bond holders to put or sell the bonds back to the bond issuer before maturity. This is valuable for investors. Let me explain. A puttable bonds equals to an ordinary bond plus an option. This option allows bond holders or bond investors to sell back the bonds to bond issuers before maturity. And the bond issuers have to buy back. Bond issuers cannot reject. Apparently, this option is favorable to investors, unfavorable to bond issuers. Now I have a question. Suppose we have two bonds. Bond A is a callable bond. Bond B is a puttable bond. Suppose all the other conditions are the same. Now the question is to all of you, you can imagine which bond's price in market would be higher. Which is higher? And why? Okay, I may call someone help to answer this question. What about Wang Yiming? Are you convenient to answer these questions using microphone?
Can you hear me?
Yes, I can hear you. Could you please speak a bit loudly?
Yeah.
So are you clear with the question? I repeat the question. We have two bonds. Bond A is a callable bond. Bond B is a puttable bond. Suppose all the other elements of these two bonds are the same. The question is, which bond would be higher in terms of market price and why? You just make a guess, right?
I think maybe the core bond is higher.
You mean bond A, right?
Yeah.
Okay.
Well, I think if we can.
Okay. I'll try to call another person and explain. Let me find out. Zhou Siyuan, are you willing to say a few words or share your ideas with us? Siyuan, I cannot hear your voice. Would you please speak loudly?
Okay. I think the callable bond is higher.
You mean bonds B?
No, bond A.
Bond A. You think bond A's price will be higher, right?
Yeah.
So you have the same idea with Wang Yiming, right? Okay, it doesn't matter. I'll call another person. What about Song Wenxin? Wenxin, are you waiting to share your ideas with us? Wenxin, can you hear me? Okay, let me find another person. Wang Jiaqi.
Hi, Professor.
Okay, I can hear you. What's your idea?
I think puttable bond is higher.
That means bond B, right?
Yeah.
Why?
In my opinion, I think just as you said, the puttable bond is favorable to investors. So the puttable bonds, maybe the investors are willing to buy puttable bonds because they have more ability to decide when to sell, if they can sell this bond to companies.
Yes, you're right. You're right. Thank you, Jiaqi. The reason why a puttable bond is higher in terms of market price is simply because the clauses in puttable bonds is favorable to investors. From investor perspective, a puttable bond is less risky. It's less risky. And a callable bond is riskier. In this way, for a bond, all the other conditions are the same. Less risky means higher return. And riskier means more uncertainty about return. More uncertainty about return. That's why usually the bond price of a puttable bonds is usually higher than that of a callable bonds, suppose all the other conditions are the same. A puttable bonds is more valuable for investors. Now let's have a quick summary on the types and varieties of a bond. The root is here, and we have the elements maturity. And in terms of bonds maturity, we have short-term bonds, usually within 1 year or 1 year, and we have medium-term bonds, usually less than 10 years, and we have long-term bonds, usually from 10 to 30 years. In some situations, we may see a long-term bonds which is 100 years or even more than 100 years. Besides this, we also have another very special type of bonds, which is called perpetual bonds. Perpetual bonds, in perpetual bonds, there is no maturity. There is no maturity. Okay. Investors can receive coupon interest forever. Forever. This is perpetual bonds. Now, perpetual bonds is not common in the world, but hundreds of years ago, perpetual bonds is quite popular. One typical perpetual bonds is the British Council. It's the British Council. Its face value is £100. Its annual coupon rate is 5%. The bond investors could receive 5 points every year until forever. As long as British government is still there, they have to pay £5 to the bond investor. They already paid 100 years. This is perpetual bond. And from coupon perspective, we have zero coupon bonds. For zero coupon bonds, in order for the bond issuer to sell zero coupon bonds out in bond market, their issue price has to be lower. Issue price has to be lower than their face value. Yeah. And then we have fixed coupon bonds. Fixed coupon bonds is the mainstream currently in bond market. It's the mainstream. So most of the bonds in bond market are fixed interest coupon. In recent years, we also have floating coupon. Floating coupon means the coupon rate can be changed or at a floating rate. The coupon rate may ties to, for example, to inflation. If we have a higher inflation rate, the coupon rate gets higher. If we have not much inflation, the coupon rate could be lower. So that's why whenever we talk about bonds, we often talk about inflation as well. Then some of the bonds, they attached an option. Usually we have two directions of options. One is called call option, another is called put option. A bond with a call option is called callable bonds. Callable bonds. A callable bonds means the bond issuer has the option to call back the bond before maturity. In this way, a callable bonds is favorable to bond issuer, but unfavorable to bond investor. Then we have a put option. A bond with a put option is called a puttable bond. A puttable bonds is favorable to investors, but unfavorable to bond issuers. By this sense, from investors' perspective, if all the other conditions are the same, a portable bonds is more valuable in market than that of a callable bonds. Then we have another element in bonds, which is called redemption. For example, a bond may issue interest one time a year. We call this single. Or a bond may issue a couple of times of interest a year. We call this multiple. Typically, it's one time, two time, or four time. The most common one is two times, but it also depends on the willingness of the bond issuers. In China, one time is also popular. Then we have another option for a bond, which is called convertibility. If a bond with a convertibility option, it is called a convertible bond. A convertible bond is the hybrid of ordinary bonds plus the option. The option allows the bondholders to convert their bonds into the stock of the bondholders, the bond issuers under specific conditions at a predetermined price. Usually, a bond with a convertibility, their bond price usually fluctuates much more than the bonds without that clause. And non-convertible bonds is the ordinary bond. Most of the bonds without convertibility. This is a summary about the types and varieties of bonds. Next, we will talk about credit rating of a bond. Previously, we have talked that we have two major risks for a bond. And these two major risks comes from the two sources of return. One return is bonds coupon interest. Another one is capital return, capital gain. And if bond issuer default, investor will lose everything. Here we have the risk of bond price in market. And the risk of bond price, the factors that could affect bond price, the first critical factor is interest rate. So, for most of the time, we call this the risk of interest rate. And for this, it is actually the risk of default, but we'd like to use a more neutral word, such as the risk of credit. The risk of credit. In order to measure the risk of credit or the possibilities of default of a bond, possibilities of default of a bond, we have another word we call credit rating. Now let's talk about credit rating. In general, we can do the credit rating in 5 categories. 5 categories. The first category is excellent. Excellent means there is almost no risk of default for a bond. Almost no. Almost no risk for a bond to default. Then good, then fair. Fair means the risk for a bond to default is among the average. Then poor, then very poor. Very poor means a bond is very likely to default. Let me ask you a question. For bonds with very poor credit rating, why investors buy such kind of bonds? by very poor credit rating, I believe investors know these bonds are very likely to default, and the money of their investment is very likely to gone with the wind. Well, this is the name of a famous novel as well. Gone with the wind means disappeared. Why investors still buy this kind of bond? Why? Let me give you some examples. Credit rating. First, excellent. A bond with excellent credit rating means there is almost no risk for the bond to default. That means less risky. Less risky. In this way, the return must be very low. Very low returns. Of course, because of excellency in terms of credit rating, there will be many investors who pursue for low risk, will buy this kind of bonds. Let's look at another side. Very poor. Very poor credit rating means a bond is very likely to default. Investors know that, but they still want to buy because although this kind of bonds with high risk, however, the return is very high as well. This kind of bonds are suitable for those investors who pursues for high return. It's fair for investors. You look for high return, you have to undertake high risk. And for investor here, you look for low risk. You have to accept the result of low return. Since return and risk always tie together, just like the two sides of a coin. This is a coin. This side we call return, and this side we call risk. So, for some of the people, they also call this kind of bonds as high yield bond. High yield bond. While some of the investors call these kind of bonds as rubbish bonds. Now you know high yield bond and rubbish bond, they are actually same bonds. Now let's look into more details. We have two questions in this topic. Of course, the first question is, what are the credit ratings of bonds? The second question is even more important. Credit rating for what purpose? We have two options here. First option, we expect to describe the level of risk. The level of risk for a bond to default. Another purpose is to describe or estimate whether a bond could earn more money for investors. We have two options here. And after this, I would like to ask you to choose one of these. Which one is correct? Which one is true? We have only one is true. This is the credit score for the credit categories. However, in reality, we have more credit categories in much more details. It's like this. For credit ratings, there are 3 very famous credit rating companies in the world. They are Standard & Poor's, they are Moody's, and they are Fitch Group or Fitch International. Let's use Standard & Poor's as example to explain. In Standard & Poor's bond credit rating system, we have 2 types. One is for long-term, another is for short-term. Let's use long-term as an example to explain. In the long-term debt credit rating in Standard & Poor's system, there are 3 big categories. One is called the A categories, another is called the B categories, and then last the C categories. In A categories, if a bond has AAA credit rating, that means that bond is excellent in terms of the risk of default. AAA here. Then we have BBB to B minus here. Then we have CCC to C minus here. Now we know, in terms of credit rating, AAA is the best. And one single C means very poor. One single C means this bond is very, very likely to default. Please be very, very careful. However, there are still many investors buy bonds with C credit ratings simply because of their high returns. Now, this is the question. This is the answer for question number 2. Bonds credit rating only evaluates the level of default by bond issuers, the level of defaults. It does not evaluate bonds yield. No. This is the correct option. This is the wrong answer. So what is called a bond yield? Yield is a very interesting word, and for most of the situations, it is used to describe the return of a bond. The return of a bond. Usually, we do not use the word yield in stock studies, in stock analysis. No, we don't use in that situation. Most likely, we use the word in bond return. However, why don't we simply say bond returns? First, it's an industrial habit. Second, yield, in sometimes there are special meanings. They usually refers to the return in the future. For example, we have this is dates, and at D0 date, investor purchase a bond. He or she is very interested in forecasting what will be his or her return if he or she hold the bond into the maturity of the bond. In this way, the bond return during this period is in the future, not the past. So people would like to talk as yield. And this is the yield to maturity. That means if a bondholder holds the bond until its maturity, what will be the return of his or her investment? Okay. In order to describe this situation more precisely, they use the word yield or yield to maturity. These are the exercises in the previous topics. Okay, let's have a quick summarize on that. What is a bond? A bond is a fixed income instrument. An instrument means a product or a tool, right? What are the elements of a bond? We have face value or par value. We have coupon rate. We have coupon date. We have maturity. And we have something else like this. And what are the type of bonds? The basic type of bonds, we have treasury bonds. We have municipality bonds. And we have commercial bonds or company bonds. Besides the basic type of bonds, we have some of the special type of bonds. We call them varieties of bonds. For example, zero coupon bonds. And we have convertible bonds. We have callable bonds, as well as portable bonds. Zero coupon bonds is a very special type of bonds. Its coupon rate is 0. The other 3 varieties of bonds are all ordinary bonds plus a special option. These options are either favorable to bond issuers or favorable to bond investors. Then the credit rating of bonds. Again, credit rating of bonds its purpose is to evaluate the level of risk for default, not for the level of yields. Not for the level of yields. No, it's for the level of the risk on default. Yes. Okay, this is a quick summary on what we have just learned. Next, we will try to talk about one of the key factors in bond pricing, which is called interest rate. Okay. In these topics, we will talk about a couple of things. First, what is the interest rate? Why we talk interest rate in bond modules? Because interest rate is one of the most determinant factors in bonds pricing. At the end of this module, we will learn the models for bond pricing. Models for bond pricing. That means what are the critical factors that affect bonds pricing? And interest rate is also one of the key factors to analyze inflation. Inflation is closely related to interest rate. So whenever we talk about interest rate, we usually talk about inflation. And then in order to understand bond, we also need to know something about the interest rate and inflation first. We'll talk into more details after the break. Let's have a break first.